Hello, hello.
All right, what's up, everybody? Man, we got quite a few people too today.
I see you got a haircut. I'm getting a haircut on Friday.
Yep.
Excited for that.
had to shave it all off. So
Yeah, I got to do the same. I'm not gonna shave it all off, but dude, it's been like 3 months.
yeah, I certainly don't blame you. But welcome in everybody to another episode of Simply Investing, and we got quite a few things to talk about, especially Solana's crash that happened recently. So
Solana had a crash recently, like on the network.
yep, the 11th crash on the network. So
I'm gonna
Solana is
Google this. This
technically
is
down,
new to me.
but welcome in, and hey, thank you guys. We've been all of a sudden gotten popular, so we're hitting up to 270 subscribers as of right now. So help us out, hit the like and subscribe, and help
Yeah.
get us to 500 there. We really appreciate it.
So Solana hit a 5 hour outage. I
Yeah,
just found that out. 5 hours. That's crazy. Like I understand it happening in the beginning because we all thought Solana was this brand new thing and it was in beta. And it's crazy because like I think 2 or 3 streams ago we talked about Solana and you were like, I wouldn't be surprised if the network crashed again and literally 2 weeks later it did.
oh yeah,
We talked about this 2 weeks ago.
yeah. We definitely did. We had a pretty long stream about it too, guys. So if you want to check that out too, it's on YouTube. So just go to the videos, go to live, and you'll see all our streams. All I think we're over 220 lives now, so hundreds of hours of stuff that you guys can go through. But welcome back in. Glad to have you guys in here. Another just trading sideways day on the market. We have the greed and fear index at 55. We have the the market cap at 1.65 trillion, up 1%. We have trading volume at 42 billion today. We have Bitcoin dominance at 51.3% and ETH at 17. And pretty much everybody's been flat, going up,
Yeah.
down, just
Chainlink has been doing really well, surprisingly. Bitcoin's actually still somewhat above its yearly open. I remember watching a Benjamin Cohen video, and Benjamin Cohen said usually around the end of Q1, early Q2, we drop below the yearly opening on the Bitcoin price. So if we do have like a drop in the market, in my opinion, the lowest prices we'll see is 35K, maybe 32K at the lowest. But I don't really see us going under 32K, like at all. Like I think 32 to 35 is like the lowest I see Bitcoin dropping this year.
Uh, I think we might hit like a low 30s if we keep going down, because like I said, there's still quite a few black swan events going on. We didn't have that much movement with the Bitcoin ETFs and spot ETFs, so I think what's keeping the prices suppressed is everyone's fears in what's going on with the economy. And one of the major things is that housing sales are kind of they dropped 18.2%, and a lot of realtors are in dead zones are saying it's been the worst they've seen in 30 years. We still have a few hot spots here and there, Dallas area, Florida, but for the most part, most of the country is kind of cooling off. It's like the bubble. It's like instead of the bubble popping, with the air is just coming out of the bubble. It's just going like deflating. So we're having a lot. Basically this is what is a shakeout, where it shakes out the market, and it's pushing like the jokester real estate agents out. A lot of the companies that are not related to it out. Hold on one second here. Let me just mute.
That is absolutely crazy though, with Solana having a 5 hour outage. What do you guys think about that, Chet?
Well, I could tell you one thing. It's I kind of foresaw it coming, because they're trying to do too much too fast, and it's kind of the same problems kept happening. People just piled in. That's why I decided, you know what, let me just exit out of my Solana position and move on with life. I at this point, if they have another crash, it's going to be pretty much dead in the water.
Yeah, it's like a blockchain that claims to be like super fast and good for payments. It's like
Yeah,
you don't need a 5 hour. Cash App hasn't even had like a 5 hour outage like that before. It's like,
no,
and if it has, it was probably like one time. But it's like if you want to be this highly fast payment processor or blockchain, it's like how is it sustainable if you've already had multiple outages, like not one or two,
Mhm.
but multiple.
Oh, absolutely. And that's the thing. If you're going to be labeled as the ETH killer, you got to be more reliable, more
You
secure,
can't kill
faster,
yourself.
everything. Yeah,
Yeah.
you can't be like nuking yourself into oblivion with that. But we're going to keep an eye out on Solana. I mean, that's the only news that they have that really has going on right now.
Yeah.
Is that they just kind of had that crash. And of
I
course, everyone's saying that this might be the end of Solana, which if enough YouTubers are chiming in that's the end, then that retail investors not going to put any money into it. So that it might actually spell the end for Solana. But we'll see. You never know. You never
We'll
say
see.
never. You just have to see. But what we also have going on also is you got to remember that the car industry is like another black swan event. The small, medium size and smaller banks that are exiting the auto loan industry and not just loaning to consumers, but they're no longer loaning to dealerships, which, if a lot of you guys don't know, they get what's called a floor plan loan, which allows them to buy and maintain their inventory, and they're only paying the interest every month, not on the principal, and then they pay off the principal when they pay a portion of the principal when they sell the car. So the idea is that they're buying these cars for less than what they're selling, and they the the cost of the vehicle goes to principal. The part of the profit goes to interest, and they keep the difference. But right now, because nobody's buying cars and less people are able to buy cars, and no one can buy like a standard Jeep Cherokee for $50,000. It's outrageous, especially for a car that used to 20 years ago go for like 22 to 25,000 on an average spec. So those cars are just sitting on the lot. They're accruing interest and they're not getting sold. And they're not going to get sold for the sticker price. They're going to have to go probably 10 to 15% below sticker price for them to get, or otherwise these cars are going to go to auction. And that's kind of like the one big thing because as these banks are not lending, they're letting go of the staff. So the underwriters, the adjusters, the loan salespeople, they're all disappearing.
We have a lot of layoffs in general right now too. It's a crazy sight to see. Like I remember us a year ago, we were talking about a lot of this stuff happening. Me and you were sitting there saying like a lot of people don't realize, but we're not in the bottom of the recession. This was literally around a year ago we were talking
Yep.
about this.
And
And
that was when we had the worst prices too.
yeah, like literally around this time last year, me and you were texting each other, and you were saying that it's not the bottom of the recession yet. And literally a year later, like we're actually seeing even worse stuff than
Mhm.
2023 happening. And on top of that, it's an election year. So you already know the activists and stuff like that are going to go crazy this year.
Oh, absolutely. Absolutely. And what's also kind of a little crazy is that we're not s- we're se- it's like unemployment has not been affected just yet. And it might be because the information is a few months behind. Some people don't start looking for work yet until maybe 3 or 4 months in because they might have had a savings, they might have wanted a break, things like that. But Google just announced layoffs, and they're also getting rid of the childcare program, which I did do a short video on it too, if you guys want to check that out. But here's some of my thoughts on why they got rid of the childcare program. I don't think it has anything to do with their profitability. on everything. I think it has just something to do with the insurance premiums go up. And for those of you guys don't know, it takes a lot of money to insure childcare. Like you got SIDS, you have a lot of things that could go wrong with like with taking care of 5 and younger children. And I know that's like it's a cool idea, right? Have in-house daycare for your workers so that they can come. But I think Google's getting rid of it because they're probably paying like 3 to 400 million a year just to ensure that part of their company, and they're it's not making a profit. It's kind of like a just an operational cost. So that's probably the reason why they're getting rid of it. It has nothing to do with they can't afford it or anything. It's just probably saying, look, the insurance is going to get higher, and this is already a gigantic risk. So we got to exit out. When I worked at a furniture retailer, they kind of did the same thing. They were selling cribs and baby furniture, and they just decided it's not worth it anymore. The risk is too high because it's basically whoever is taking care of the child or selling children's products, you have 100% liability for SIDS. If you guys don't know what SIDS is, it's sudden infant death syndrome. And that's the scariest thing that could happen, especially if you're a business that's involved with that. I mean, there's really no price you can put on that. And the risk is astronomical. So that's probably why they exited out. And I see a lot of other benefits exiting out of the tech sector, like the cafeteria benefits, the cafeteria benefits, the lounge benefits and things like that. The only thing I think they'll keep is like the open atmosphere office. Nobody likes to really work in a cubicle, but I think all those like nifty add-on features like the free laptops and everything, the free just the free like the free stuff that they got, like the free like the company phone, the company laptop, the company card, like all that stuff's going to start retracting back, especially since funding like commercial paper right now is not even being touched, so they can't go and issue commercial bonds. The only ones who I think can are like Procter and Gamble, Coca-Cola, and what's the other, Johnson and
I'm
Johnson,
pretty sure.
long
I'm
standing.
pretty. Oh, I'm sorry. I'm pretty sure Tether has a lot of commercial paper. They had a lot of commercial paper, and I think what they do is they buy a bunch of Bitcoin when Tether, when they've made some type of money or something. They buy a lot of Bitcoin. That's what's been happening. I think in the past year and a half, Tether's actually been buying Bitcoin as like reserves.
Uh, Absolutely. And but to let you know what commercial paper is, guys, is when I say commercial paper, I mean what are corporate junk bonds. Like they're unsecuritized bonds. So if the company can't pay it back, you just kind of run that risk that you lose out. But if the company does pay it back, you get a higher interest rate than a treasury bond. I think Tether has treasury bonds, but they don't have commercial junk bonds. They don't have that type of bonds on their books. So that's because if they did, it'd be very hard to maintain that stable price because junk bonds go up and down, up and down, up and down. And like if you had the bonds of Carvana, you would have lost out because they basically are worthless because the company's not going to be able to pay you back right now. So they're kind of worthless at this point. But it's just one of those things you just gotta pay attention. You gotta pay attention to it, even though it's something we don't normally think about. But a lot of companies can't even get that type of bonds underwritten and paid out. Even a lot of like brokerage firms, investment banks are closing their doors because they just can't do the business right now.
I've seen
Nobody
I've
fees. Oh, go
I've
ahead. Go ahead. Sorry.
I've actually seen a Carvana office or in my area, and it's like kind of dead. See, Carvana was mainly good in 2020 during the beginning of the pandemic, but then after that, I guess it was a combination of bad business moves and the economy.
Yeah. Speaking of Carvana, we will be having a video of that. They did spike up over the last year, so you would have made quite a bit of money. But if you look at the last 3 years, they're kind of down significantly. But let me just share this tab, get up here, because what happened with Carvana is that things just kind of they overbought the inventory, and because during the height of the pandemic they bought 250 um G wagons at no, I'm sorry, I didn't buy 200. I'm sorry, they bought I think they bought 3,000 G wagons at $250,000. And now you can only sell a used G wagon for probably about 150, maybe less than that. And that's what hurt them, because that was a lot of money stuck into a luxury car that now cannot be sold. But before we continue, let's give Crypto Dream a shout out, one of our great longtime supporters. Welcome in here, buddy. And go like and subscribe his channel. He's so close to 500. Let's help him get to 500 subscribers and keep pushing his channel up. And definitely give a lot of his videos a good watch too, because he has a lot of interesting videos out there about crypto and about his take on it and his viewpoints on what's going on in the economy as well. But the one thing that's here in Carvana, back to Carvana, is that every state has a different sales process. And since every state has a different sales process, every they're not compliant with a lot of states. So like if you go to like Florida, if you bought a car in Florida, you really just need like one sheet of paper. Boom, you can go get your registration and stuff like that. But in Arkansas, you pretty much need a booklet of stuff they have to give you to go get your paperwork. And Carvana doesn't give that. So there's a lot of people who are not getting the proper paperwork to register their vehicles. They're still paying on the loans, and then the loans get reversed because they can't register. And Carvana's in this huge scandal with that. Excuse me. So, and that's kind of hurting their sales too, because the cars are basically being sold at a loss. Now, before the pandemic, Carvana was known for undercutting the market. Now, Carvana can't compete with the market because the local cash buyer dealers that just pay cash for their inventory and sell it when they sell it. Well, guess what? They're thriving, and they can knock down their prices to whatever the market is telling the price should be for these cars. So they're able to succeed where Carvana can't. It has to sell this, and it also doesn't hurt. It also doesn't help Carvana that the founders of Carvana were involved in an alleged fraud prior to running this business. So it does not bode well. I mean, it's a great idea to sell a car online, but now millennials and Gen Zers are waking up, the ones that are between 20 and 35, saying, wait a minute, Carvana's overpriced. Why don't I just go walk around and shop and pick up and look at car dealerships and see which one's the best deal? So let me just put that in here for you guys.
I know if I'm gonna buy a car, it's not gonna be from Carvana. Them prices are just crazy.
Yeah, I mean, it used to be like if you wanted like a used luxury car, you could have gotten one for under 20,000 off of Carvana, where the dealerships were selling it for probably close to 30. Now Carvana is selling it for 40, and the dealerships are selling them for like 25. So we kind of had to flip, and that's kind of what happens in these markets. Is the buying patterns and the trends and the values can flip. And unfortunately for Carvana, they got way too big, way too fast off of the IPO, off of venture capitalists and corporate investment. So, and now they're kind of stuck because the value is going down, not up, and it's only going to go down more as the economy continues to slow down.
Speaking on prices, like 50,000 on a brand new vehicle nowadays. I mean, 50,000 to some people, like if you're really wealthy, that's probably not too bad at all. But like for your average person, like that is kind of crazy if you think about it.
Yeah, that is usually, like a Corolla was like 18,000 for a base model, 23, 24 for the high end, for the top of the line one, and maybe like 30,000 for the sport model. Now you're looking at like 25,000 for the base and probably 40 to 45,000 for that luxury sport model of theirs. So it's like everything shifted up, but everybody's ability to spend has not shifted yet. So it's either that it's going to shift up, and then the economy will keep chugging forward, or the prices will shift back, and we're going to see a lot of big companies get shaken out of the markets, get shaken out of business, unfortunately. And that also leads into more layoffs, more reductions, more benefits pullbacks, more of a lot of things. And it's like expect bigger companies like Yellow this past summer to just bite the bullet.
You
So
know, I expect to buy a car within the next year. I'm not buying a car this year, but within the next year, you know, I'll see how the car market is. You know, prices on everything.
yeah, and you're also like I think the prices will get back to a little sense of normalcy because if people can't afford it, they're going to eventually adjust. But you're going to see a lot of dealerships go out of business. You're definitely going to see, especially the smaller ones, or like the people that have one Ford dealership. Now you won't see something like those, like the Hendricks dealership, where they have like 500 dealerships across the nation. They'll be fine. They're going to survive this.
What
However,
about, for example, you've been on Moberly, right?
yes.
You've seen all the dealerships like the Cadillac, the BMW, the
Mhm.
Chevrolet, Mercedes. They're
Yeah.
all in like one area. Do you think those will be affected?
I think nationwide, a lot of those dealerships will shrink. And here in Northwest Arkansas, they probably won't because there's a lot of people moving to this area, so they should be fine because they make most of their money off of the services, not really the sell of those cars.
Gotcha.
So, but I do see like smaller towns like Joplin. If Joplin has BMW dealership, it probably won't have a BMW dealership in 2 years because there's not enough people to buy those cars. Whereas here, there's enough people and they're willing to travel to get a BMW. So, and you have to take it to a BMW certified dealer to get it serviced. You can't just take it. You can't take them to the regular places because they're too complicated now. So they make a fortune off of their parts and service department, and then they make good money off of selling the cars.
That's
But
why
now they
those
have all.
cars.
I'm sorry.
I guess that's why those cars like are so hard and unique to work on because they realize like if it is that way, then people will spend more money on the services.
Yes, and the more performance based the car is, the higher the cost is to maintain it. So that's why the exotics get up to like 15, 20, $30,000 to maintenance them. But the one thing I could say is that like those luxury car dealerships have switched over to more like a Tesla version, where you go in, you pick your specs of the car you want, they make it and they send it. So you're most people getting a brand new car from the dealership is most likely ordering a custom built car or a specked out car to what they want. Whereas if most of those other cars that you see on a lot are probably used or certified used cars that they have. They don't have a lot of new cars. They have demo cars and then they have used cars and they're certified used. I think most likely they'll end up being fine in the end, but we just won't see those dealerships in random spots. You you used to be for the last 5 years, you can go to any town that was at least 50K people or more, and they had a luxury dealership. Now, unless if their town is 100,000 or more, they probably aren't going to have them because they'll just there's not enough demand and not enough people able to afford those in that area. And usually for luxury vehicles, people will travel just like with like a Rolls Royce. You don't wish there was a Rolls Royce down the street from you. They go 500 miles to the closest dealership. So that's that's just kind of how it's going to be. But that's another crack in there. And then like the final crack that I can only see is that people are going to eventually not pay their student loans, not pay their car notes, not pay their rent, just stop paying bills and just pay maybe the necessities to move to cheaper rent cheaper places to live. They're going to not shop at Whole Foods, kind of go to a local grocer. I mean, Aldi's has been tearing it up. They've been growing consistently, and their prices are cheaper than Walmart's neighborhood market. So I can see people moving, kind of just shifting down to that. So if consumer spending slows down before we get to the third quarter, we're probably going to see a downturn for the third and fourth quarter. And this past fourth quarter was on paper better than the year before, but also the the retail borrowing for goods and services went up something like 43% for that quarter. So that means more people, almost 50% more people borrowed money to get stuff during the fourth quarter. And that's just something that's just not sustainable. Eventually you run out of money to borrow. And then you got to start paying it back. And then you got to pick and choose what you're paying back. Especially since now rent moratorium is over, student loans forgiveness is kind of ended, but not really. I mean, there's stuff in the works trying to push it back another year, but eventually the hens come to roost. You got to pay those bills back, and unfortunately, I think Americans are just going to pick and choose, and most likely, most people will pick one car, pick a cheaper place to live, and get cheaper food, and they're going to start trying to save money, and they're not even going to bother paying them back. Because most people, if the debt's too much, they just walk away, and they'll just go through bankruptcy, which means these companies will be out of business in a few years because they're not making any money. I do know that the payment processing companies that process mortgages, student loans, debts, they do all that stuff. They finance and they process the payments. They're starting to struggle because they're noticing 11, 12% default increase rate. So it's kind of not, that's kind of like another big kink in the armor of the economy is like if people just stop spending and they stop paying back the debt, the whole cycle is going to kind of implode on itself. Because like your local community bank, like all the credit unions rely on the debts that they've given to be paid back on a consistent basis in order to keep lending money and operate business. And if they can't do that, then they can't pay their pay their debts, and they can't pay they can't pay their depositors, and then now we're in another situation. So it just one that's probably the last kink, and it may or may not happen. But like we always say, some of these things may or may not happen, but they're just there. And either one's going to happen, none are going to happen, two are going to happen, or all of them are going to happen. A black swan event means that they're all going to happen at once and kind of cascade each other, and that would be a very bad scenario. But you just don't know, and usually crypto is kind of like the canary in the coal mine. If crypto just starts suddenly dropping, it's most likely because of the what's going on in the economy. But I don't really have much other to say on that.
Speaking on, yeah, the market, it's like regardless of what happens, like I'm DCAing into the markets. Like, yeah, it is a risk, and everything in life is a risk, but it's like I'm delaying a lot of gratification and, you know, stuff like that just to be able to, get through this year and DCA through this year because, it can be a struggle. The bear market, I can't believe that we've already, gotten out of the first 2 years of the bear market. We're already in the last year of the bear market if we're on that 4 year cycle. I
Mm-hmm.
say that every day. Like, it's crazy how fast time has been flying. But at the same time, it's like, you know, it can be tough, holding and DCAing for a while.
Yeah, especially since you're seeing the markets go up, down, left, right, side to side. You kind of have to be a rock. Just no matter how much the water's moving around you, you're kind of staying stationary. But make no doubt that you are getting that the motion is kind of chipping at you a little bit. That's where we say you got to kind of stay fast a little bit. Excuse me. But I can say that the markets will eventually rebound. Like this isn't all doom and gloom. Like what goes up must come down, what goes down must come back up. So, and if you look at markets and the economy overall, every time we took a huge dip in comparison to the whole economy, to the whole spectrum, we didn't dip that much, and then we made a bigger recovery. So this dip it's going to hurt, but the economy will recover. Everything will get back to normal, especially since a lot of chip manufacturers they're moving out of China. A lot of semiconductors are moving out of China and Taiwan. A lot of it's coming to New Mexico, Arizona, Mexico, kind of coming closer towards the United States. But it kind of rings the same thing like Henry Ford did when he first started Ford. It's like if you want to sell to the masses, you also got to make it in the place where they are and pay the people to be able to afford it. And I think that's where we're kind of stuck right now. The pay of the average worker is not quite there yet to where they can be able to afford to maintain like even one car household, even off of a two-person income. But at the same time, we're no longer the same economy we were 50 years ago. We went from like manufacturing and a little bit of consumerism to now we're almost like 90% consumerism. So most of the money is really just kind of moving around, not really producing anything, just kind of moving from one place to another.
Heavy corporatism. That's what it is. It's big corporatism. That's where back then, it was less of that. I mean, we still had a bit of that, but it's like you said, it was a little bit of consumerism, but mostly nowadays it's just all consumerism. You know.
Well, yeah, that's true, but like I wouldn't say we're on that version of capitalism anymore because that was like way back in the day where you had company towns where towns were by the factory and basically that one factory supplied everything in that town. Now that's kind of now like when a plant leaves a town, it hurts, but it doesn't hurt as bad as it did way back in the day. Because like when Rockefeller closed an oil plant, he shut down everybody, including all the other small businesses that were supported by the people living there that worked at that plant. Nowadays, with work at home, online opportunities, and you got a lot of Web3 opportunities, Web2 opportunities that you can work from home. Even like customer service jobs, sales jobs can work from home too. You can live out in a small town in America and have a decent job. And if the plant closes, it doesn't really affect you. Other than maybe you might have to travel a little bit more because the grocer might go out of business because those people might move. But we don't have company towns. So we're kind of in this like quasi where it's somewhat like 50 years ago, but also the most Starbucks, Walmart, Target are most of the consumer based goods. And that's what people spend. Like people spend, I think it was like 30, like the morning coffee industry is $32 billion just for the morning coffee, and it's constantly growing. And people are willing to spend 8, 9, $10 for a cup of coffee. But then when it comes to other things, they're not willing to spend it. So like the cars, the bigger purchases. But uh, I think I saw someone's thing channel. I have to add it up here because it was like it was 8.49 with tax where that person lived, and they got a cup of coffee every day from Starbucks every day for like the whole week. So you're talking if there's 30 days in a month, 30 days they got a cup of coffee. So you times that by 30, you're looking at
Times
$254.
that by 365, and
Yeah,
that's
exactly.
That's $3,100 a year.
So I mean, $3,100 a year on coffee. Whereas if you put that into the market in the last 10 years, you would you would have close to probably about 60, 70,000 now, and that's not counting the interest or the gains that you would have made over that time because everything was significantly cheaper 10 years ago.
Yeah.
But
Just
with
two guys. crazy to think about just in 2014 to now, like the cost of things just in the past 10 years.
Yeah, I'm and this kind of is like a touchy point. Like a cup of coffee isn't going to save, but like, what could you guys do with an extra $3,100? And if we're just cutting out coffee, what about vaping? What about cigarettes? What about alcohol? What about some of the stuff you really could live without, like the streaming
The Mary
service?
Jane.
Yeah, let's just put. I think the average person has 5 streaming platforms, so you're looking at Hulu is 1989 after tax. What's Netflix $15?
Yeah, something like that.
89 plus 15. Oops, let me just clear this out here. 19.89 plus 15 plus I think Disney Plus is like $8. Um oops. 89 plus 15 plus 8.
Shoot, Coinbase One is $30 a month, but it saves you fees on Coinbase. But like even that's a subscription there.
Yeah. But let's just take streaming platforms, right? So we have that. What's another one of the big ones? You have Netflix, Hulu,
Hulu.
Disney Plus I put in there. What is the other one? Let's just say you got Funimation in there, that's $12. Um let's just say you're paying for Paramount, that's another $15.
Spotify if you're paying for it.
Well, yeah, what's Spotify? I
It's
can't
probably
tell
like
what's
$10 maybe, something like that.
okay, so 10. So we're already up to $80 a month for that. So
If you have all of those.
times 12. So that's another $1,000. How it's like the average, I think the average vape spends what, about $200 a month? Average person who vapes.
Well, you're spending $20 every like 2 weeks. So me as someone who vaped, I was spending about 40 to $50 a month. About
Okay,
yeah.
let's just say 80 because for someone who uses it a lot, right? So 80 times 12. So it's another 960. I know cigarette smoking is ridiculous. The average person spends on that is plus 3,500 a year on
For a
cigarettes.
pack of Marlboros, it's like $10, $11 now. Ten ninety
Oh yeah.
two for a pack.
And you go imagine what it's like in California, New York, in the Northeast, all that stuff, right? So we're already up to $8,560 a year off of stuff you can do without. And I think that's what kind of plays into when these older people, especially older wealthier people, keep saying don't buy that Starbucks, don't eat out. Oh, we haven't even counted out eating out. Let me count that out. You work 5 days a week and you go to an office, so it's $25 average in the city for a meal, times 5 times 52. It's another $6,500. So that's $15,000 just gone on unnecessary things. I think this is where this comes from. It's like if you don't buy that cup of coffee, it helps. Not a lot of people are understanding that's $15,000. You do that
People
for
focus
4 years, you got yourself that $50,000 down payment on a house.
when you
So it
see
is.
when you say that saying, people don't really think of it like, oh, well, it means in other aspects. No, a lot of people just hyper focus on it's just a cup of coffee, but people don't think about the mindset behind it. And the mindset behind it is when you cut out stuff that you don't need, when you actually get a calculator out and you calculate all of those on like stuff you don't need, you'll kind of sit there and think, I'd have more money. And if that makes you sit there and react in a surprised way, then it goes to show, you're overspending.
Oh, absolutely. And I think that's what the whole argument is that yes, because even my own mother would tell you this is probably true because this is what an accountant does. They just go through line by line of everything that you're spending, whether it's personal or business. Especially with businesses, they just start, okay, what do we don't need? Cross it off, and that's where you're starting to see the layoffs, the benefits disappearing, things like that. So like this all kind of plays into it. But you guys got to understand, it's like there a lot of young people Cody's age are saying it's impossible to get a house. But I just added up in 4 years, so from 23 to 27, you can get a house. And this is off of an average income. And you guys are spending this. And I even see it with the guys that work on our crews. Like constantly every morning they go to Come and Go and they buy like 5 or 6 drinks, snacks, all that. Where you're spending like another $25, $30 a day instead of just bringing stuff with you. So I'd say I get it sometimes. Sometimes you just need a cup of coffee to start your day. But even that, like that used to be when I was 20, like it was like 79 cents for a cup of coffee. Now it's like almost $3 for a cup of coffee.
Even if you go to a gas station, yeah, it's like $2, $3 for a cup of coffee now.
So, and it's those microtransactions. They don't realize it, but they add up. And it's the same thing with business. They just add the freak up on here.
It's the same thing with staking rewards. Like I get about $3, $4 a day into polka dot staking rewards. That's literally like a gas station cup of coffee every day. And
Absolutely.
it adds up when you're getting that every single day for a year. That might not be as much as first, but when you get into a bull run and that coin, goes up in value and you've been getting those staking rewards, then it's like it all added up, like same thing with Polkadot. Like, if for example it goes back to all-time high,
Mhm.
all those staking rewards will be worth a crap ton.
Oh, absolutely. And now this, I kind of went through this because I'm pulling it back to a big corporation. So now imagine what a microtransaction is for a company like Google. Probably like what, 15,000, 20,000, right? So now imagine just add like 5 to 6 zeros onto the 60,000. And that's what Google's doing. That's what their accountants are doing. And they're saying, oh, they're going line by line. They're just picking stuff off, just like you would do it with your budget. Just pick stuff off. And it's not surprising that they're starting to lay off a few people, mostly middle management, kind of, the unnecessary bureaucratic tape within their organization, they're letting go. And all companies will start doing that. It's like, do we really need like we have a general manager, but do we need a sales manager as well? Can't the general manager just be the sales manager kind of deal? You see what I'm saying? So you start knocking off salaries, you start knocking off benefits, you start knocking off things until you get down to where you're saying, okay, we're saving enough money, because what their financial team and advisors and accountants are saying is these big companies like, look, you got to start reserve the profit, keep that money and save it, because there's going to be a rainy day. And if the rainy day doesn't happen, great, we got all this money. And unfortunately, not many companies operate like that until they get pushed into that area. So like Apple and Berkshire, they have monstrous amounts of cash. They don't care. When the market goes down, they just start buying out their competition or whoever they want to buy out. Most other companies, when they hit that, they start saying, oh crap, we're spending too much, we're doing this, we're doing too much, and they start constricting. So that's where a lot of these, you're going to see layoff after layoff after layoff after layoff. But you guys got to realize it's not really the day-to-day grunt workers who are making the machine of the business work. It's really the person in the middle, or like, do we really need a regional manager and a division manager? Why don't we just have a division manager? Or why don't we just have a bunch of regional managers, get rid of the division managers? Like, kind of, that's what they're doing right now. They're getting rid of all this overhead in between the top executives and the front line managers, and they're just kind of getting rid of all this fluff in the middle. And that's what's going to cause the market, because everyone's going to think everything's going bad, but really what they're doing is they're fine tuning. It's kind of like you're running a retail store. You had 20 salespeople, 10 customer service people, and 5 managers and 10 warehouse people. And then you realize, like, well, I can run the business with 2 warehouse people, 4 salespeople, no customer service. The salespeople can do the customer service, and 2 managers instead of 5. That's kind of what businesses are doing. And unfortunately, they're going to go through the Jack Welch cut to get down to that, and they're just going to start cutting the bottom 10%. So if you're a middle manager and you're at the bottom 10% of performance, you're probably going to get cut. And then because those positions are no longer existing at other companies, your performance, if they're a poor performer, that performance at another company makes it hard for them to go get a job somewhere else. So they have to go be technically underemployed by working a job for less money and less credentials than they have. So that's kind of where we're headed with this economy. It's interesting, but that's kind of like where the job market's going to be headed to, and that's why companies are making these cuts, is because it's just feasible to do it that way.
Yeah.
So that's all I really got to say for this hour. I mean, the markets are going to be flat. They're going to trade sideways, like I say. They're just going to go up a few weeks, down a few weeks, up a few weeks, down a few weeks, up, down, up, down. We're not really going to see a lot of you're not going to see a lot of traction, more or less. We're just going to see a steady, slow decline. All I can say is just pay attention. Don't invest in anything crazy, especially if you're in crypto and you're on these meme stock tokens.
I'm waiting for quarter 3 and quarter 4 of this year because I feel like Q3 and Q4 will be pretty exciting. It's like something in me is telling me that actually quarter 1 through 3 is going to be sideways, but something's going to happen in the fourth quarter. I feel like something's going to happen starting October, November of this year. And I feel like this summer we're going to get like a boring summer. I feel like every summer since 2021 for crypto has been bad. 2021 summer, Bitcoin lingered at around 30K. 2022 summer, we had ETH going down to 800, Bitcoin going down to early 20Ks. Last summer, we had the Binance FUD, and we had the SEC calling everything securities. It's like this summer, it's been every single year that in the summertime, crypto just kind of goes through this summer lull.
Oh, absolutely. And it just seems like we're probably still going to go through it again. Just, it's going to be the same thing. But just keep in mind, folks, that most big market crashes tend to happen either in March or April or October. They don't really happen in like a June or July type. Like every crash you look kind of happens in spring or in early fall.
Oh, crypto did in June of 2022, but that's really it. Like, have you scooped up Ethereum in June of 2022 when it went to like 850, $900? Like, you're up a lot on that. June 2022, I think, was the absolute bottom for Ethereum. Like, even if we go through another quote unquote black swan event, I really don't think ETH is going to drop from its current price 2,300 all the way down to 850 again.
Mm-hmm.
I think June of 2022 was the absolute best time to buy Ethereum.
Probably, but
I think that's the bottom for it.
guys, also guys, your crypto's a little different. It's too new of a market and industry. It's still finding where its pattern is. But if you look at historic crashes in the economy, they always kind of come around March and April, and then they kind of come, the worst ones come in the October. So like the 1929 crash, the 1987 crash, what was the other one? The 1993 real estate crash. They all happened in October. So it doesn't look like we're going to have that bad of a crash where it grinds the whole world to a halt. It's just we're just having a correction. Hopefully everything went well and the balloon's just deflating and we're just letting the air out of the balloon. But if this summer, if the housing market booms again and everything goes great, then we might be in a part where we're pumping up the economy and putting too much air and eventually it's going to pop. But I have a feeling the air is just letting out and just the balloon. We had the balloon, now it's going back to a normal size, and that's the economy's kind of going back to a normal size. It's not popping, and we have to restart the economy.
What are your takes on like how 2025 is going to play out when it comes to like not just crypto but like financial markets in general?
Um, I would say that well, one, I would say like we're not going to see a rebound in the financial markets until the end of 2025, maybe early 2026. Crypto probably will be the first to rebound, which I think is going to be like early to mid 2025. I don't think we're going to see a bull run this year. I think it will come towards the middle of next year. But also, but it also depends on what happens this election cycle. If we get another Democratic candidate, we're probably going to be just staying the course with the economy, probably going the same direction it's going right now. If we get a Republican candidate, it really depends, because a lot of it, well, one, we're exiting out China anyway, so really they can't really hurt a diplomatic session with China on that. But if they go out, if they come in, we're either going to see a lack of employment opportunities, or we're going to see a growth in employment opportunities. But the thing is that they kind of want people to go back to the plants, and people don't want to go back to the plants. People don't want to work at the plants. But we also have AI coming in, and AI is saying maybe you don't have to go work at the plants. Maybe you can make some AI robots to do some of this grunt and tedious work that nobody wants to do. Kind of like the septic lines clean out. Like usually the newest guy working would go into septic lines, clean out the septic lines of the human waste, and make sure all the lines are fine, and fix the pipes and stuff like that. Well, you probably soon can get a robot to do that, right? Same thing with working in a chicken plant. Probably can get a robot to do it, or a big machine to do it, instead of having all these workers. Unfortunately, we're going to have a lot of displaced people, but all those displaced people don't want to go back into working in manufacturing. They want to do something else and get more paid better for it. So we'll probably see an increase again in the tech world, with Web3 and crypto companies hiring and paying, because they're paying people like 200, 300, $400,000 a year to do the Web3 coding and stuff like that, because there's not a lot of people who are qualified to do it. That's going to, wherever they land, which it seems like Austin, Texas is where they all are, they're moving to. So Austin might see kind of like a San Francisco boom for the next 5 years, as more and more people keep moving into it.
Could be a good place to get some networking opportunities.
That too. And also more and more people are making money online with side hustles. So I don't think they're going to go back to manufacturing. There's no point in bringing car manufacturing back to the US when less and less people want to do it. It's not like you're doing like a Rolls-Royce and Bentley plant where they are artisans who hand do everything. You're just doing machine assembly line production of base model cars. They the people 20 to 40 don't want to do that work, and only the people that do want to do that work tend to be like 50 and up, because that's what they came in, they worked that one job, they've been there for so long, and they kind of want to retire there. But once those people are retired, which may happen in the next 3 to 5 years, I don't think manufacturing is going to be the next thing here. I think it's going to be a lot of higher end technology, building, growing, developing, like the next stage of technological revolution, whether it's AI, virtual reality, space, and aeronautics. That's where we're probably going. And all the parts are made overseas, but all the design and intellectual property are done here. So that's kind of my thoughts on where we'll probably go. We're probably going to have a steady decline up to the end of 2025, and then we'll probably start to see some recovery. But all depends on how people feel after this election, because it's looking like this election is just going to be crazy, with people probably being even more divided, and we might see a third party pop up out of it. Who knows?
A lot of people are divided. Like I see it a lot. That's just how society feels nowadays. Like it's almost like it's just a forced agenda to keep people divided.
I don't know if it's a forced agenda. I think it just played out that way. You got way too many people involved in the system, and they're all making decisions that they think are best for themselves. So you got 420 million people in the US making a decision based on what they think would be best for them, and it's just correlated out to that. Now you do have some people kind of making like the divide already happened, and you got some people kind of wedging it wider, but you're really not going to have too many people. I don't think it's going to wedge even further. What I think is going to happen is a third party is going to come up, maybe a fourth, but a third party is definitely coming up because Gen Zers and younger millennials don't align with either party. And if they're liberal, then Democrats are not progressive enough. If they're conservatives, conservatives are not conservative enough. And then there's a lot that are leaning towards libertarian that are saying, "Hey, I just live, let live" mentality. So we'll have to see because now a lot of Gen Zers are voting age, and we're gonna have to see how they're gonna vote this election. And we'll probably have even bigger turnout this election than we did in the last election. Which, by the way, guys, the last election had the highest turnout in U.S. history for voters. So I think we're probably going to landslide that one this time because a lot of younger people are now seeing how, that they do have a voice in this process. And they might start voting out like older people, getting people who are younger more towards their sensibilities. But like I said, we just have to wait and see. We just have to wait and see. Kind of have to ignore the FUD, take all the news that's out there for a grain of salt, and just see what the actual results are in with everything, the economy, the elections, how businesses are performing, things like that. So, but all I can say is expect more layoffs. Unemployment, in order for us to have a healthy economy, unemployment has to be around 6%, but we'll probably spike up to 8, maybe 10%. It depends what's going on. A lot of zombie companies will start closing doors. And of course, we have we'll have a lot of financial institutions closing their doors on lending. So I think the debt is going to get pulled out. That's going to get paid off in the long run, eventually pulled out, and nobody's going to get more debt. It's kind of like we didn't have like a 1929 crash, but we had enough bad experiences with banks and money that a lot of young people won't bother getting into debt anymore. There'll be a cash and carry. They have the cash, they'll buy it. If not, then they'll keep on walking. But with that said, I got to get going. We've been on here for an hour, and we really appreciate all you guys. We had quite a few people in here, even some people on Twitter joining us. So I really appreciate you guys coming in. Give us a like and support and a subscribe. Follow us when we have follows for new videos and everything. Also, definitely, go down if you want to watch, go to YouTube, go to our page on YouTube, and you can just watch all the videos there. And I hope you guys enjoy. Give a like and subscribe because, as always, this video is supported by you guys. Stay safe and have a good day, folks. Hope you're living your dream there.